Our next guest says it is anyone's guess where the market will end the year, but he does like where U.S. equities are relative to alternatives. Joining us from San Fran this morning to talk market strategy, Rafael Resendes. He is co-founder of the Applied Finance Group. Rafael, good morning. Good to see you.
Great to be back, Mark. How are you?
What do you mean you like it relative to alternatives?
You know, when you look at what's out there in the marketplace right now, whether it's junk bond spreads relative to Treasury bonds, those are at all-time lows. You look at foreign markets are just strong as all get out. And I think emerging markets are up about 20%, 22% over the last year. The U.S. market as a whole looks really attractive here. Long term, we're looking for U.S. markets to return 4 to 5% above 10-year Treasury bonds. So we're looking for 9 to 10% long-term returns, which in today's market environment I think is very attractive.
And what part of the market do you think will do best?
I think that's an interesting area. I think we've been transitioning now for a couple years where large and small have been roughly equal performers. At this point in time, we start to favor the large cap stocks. We think that on a relative basis, their valuations look a lot more interesting. In the stocks that we follow, we're seeing a lot more, a greater proportion of large cap stocks well priced compared to their current intrinsic value. And with international markets so strong, international economy so strong, we see the large cap stocks really being able to take advantage of that economic strength and continue to deliver on consistent earnings and economic growth for their shareholders.
Rafael, a couple quick questions for you. One, Mark and I have been talking about what Walmart said today, that they're seeing the same pressures on customers in many of its international markets as in the U.S. We're calling it the discordant chord here, but does that change at all your view of, hey, anything overseas is a good buy?
No, I don't think anything overseas is a good buy. I think, you know, everything always gets back to what is it that you're paying for. In very simple terms, we all know Mercedes are great cars. Right, but if you pay $300,000 for a Mercedes, it's a bad buy. So everything gets back to relative to the price that you're paying and the expectations that you're buying in today's price. We've seen a lot of bad news built into retailers, and while they didn't have a bang-out quarter in terms of their numbers, they certainly were priced to deliver to the upside given to the level of performance.
Rafael, I'm sorry to jump in, but we only have 10 seconds, and we've been teasing you as panting over PetSmart.
Right. I think there's a couple quick notes on this company. Number one, its largest competitor has gone private, giving PetSmart the opportunity to really grow, whereas its competitor is likely to harvest cash. So PetSmart has some interesting growth opportunities. Also, as a company, they've shifted into more value-added services. Pet hotels, grooming, training, all of those things are going to be really beneficial to their margins and ultimately flow through to their bottom line while they continue to grow same-store sales and expand new store openings over the coming years.
Okay, Rafael, thank you very much. Got to say goodbye to him.